The market is closed, and the last reported closing price for Opendoor Technologies Inc. (OPN) on the NASDAQ exchange as of 4 p.m. Eastern Time, Friday, October 24, 2025, was $8.01 in the after-hour session, closing slightly higher than the regular session close of $7.97, which represented a significant plus 16.50% gain for the day. While the massive single-day surge immediately grabs attention, the immediate insight, the piece of information that truly challenges the common narrative about Opendoor, is that this stock's wild, volatile behavior has little to do with a sudden positive change in the housing market and everything to do with a violent short-squeeze dynamic combined with a total business model pivot. The expectation surrounding Opendoor is usually one of caution, given its capital-intensive iBuying model and the painful history of its major competitor, Zillow, exiting the space entirely after massive losses. The reality that investors are overlooking, which creates this massive upward tension, is the company's desperate but serious attempt to shift to a capital-light, AI-first and agent-led platform, a strategy that the market is now punishing short sellers for not taking seriously. This stock is currently a high-stakes battleground, where the technical setup is driving the price more than the shaky fundamentals. Let's examine this recent movement. The stock's jump, even with the closing price in the high single digits, is a direct result of its high short interest and the psychological tipping point created by positive news. Just look at the trading volume, which has been consistently massive, sometimes exceeding 200 million shares in a single session, a clear indicator of a massive speculative battle. The stock is up dramatically, over 700% from its 52-week low of around 0.51 cents, which is a textbook example of a highly volatile turnaround narrative capturing the imagination of traders, especially those using platforms like Robinhood stock trading for quick speculation. The fundamental reality of high mortgage rates, which are throttling overall transaction volume in the U.S. housing market, suggests Opendoor should be struggling to turn a profit, and yet the stock price continues to defy gravity, which is where the tension lies. Institutions are divided, a common pattern you see with such deeply contrarian stocks. While some high-profile hedge fund managers publicly criticize the iBuying model as garbage, the recent disclosure of a major stake by a quantitative trading firm hints at sophisticated algorithmic players recognizing the technical leverage inherent in the short position. This conflict among the smart money is fueling the volatility that retail investors using any online investment platform are riding. Digging into the recent corporate action helps explain why the bulls are finding a foothold despite the tough macroeconomic environment. In August, following its Q2 2025 earnings, which saw a revenue beat but a very weak Q3 guidance, the stock plunged, exactly as expected. The guidance projected a dramatic revenue decline to between $800 million and $875 million, far below the consensus of around $1.5 billion, and a return to negative adjusted EBITDA. This was the reality check. However, the subsequent, unexpected pivot in leadership and strategy changed the entire game's dynamic. The appointment of a new CEO, Kaz Nejatian, a former COO from Shopify, and the return of the co-founders to the board signaled an institutional-grade effort to stop the bleeding and implement a radical new vision. This is the unexpected angle. They're moving away from the purely capital-intensive business of simply buying and holding homes, a model that led Zillow to disastrous losses, to one that aims to be AI-first and agent-led. The expectation was that the company would simply retrench and wait for the housing market to improve. The reality is they are attempting a surgical strike on their business model's central flaw, capital intensity and inventory risk. Opendoor's foundational business model, iBuying, centers on directly purchasing homes from sellers at a predetermined, algorithmically generated price, making quick, light renovations, and then reselling them. They make their profit primarily from a service fee charged to the seller and the gross margin on the resale. The core vulnerability, as was brutally demonstrated when the housing market turned, is inventory risk. When prices drop or homes sit on the balance sheet for too long, the cost of capital and holding expenses eats away at the already thin single-digit gross margins, resulting in massive net losses. The new strategy attempts to address this head-on by scaling up capital-light models like Key Connections, which leverages the technology to facilitate transactions for real estate agents, allowing Opendoor to participate in the transaction fee without having to acquire the physical inventory. They are essentially transitioning from being a principal, buying and selling houses, to being an infrastructure provider for agents and the transaction process. This shift is a massive positive for the long-term sustainability of the enterprise. It reduces reliance on debt financing and lowers the catastrophic downside exposure to a housing market correction, which is a major concern for investors looking at the broad real estate sector, including players like Fidelity Investments who hold real estate funds. Let's dissect the Q2 reaction, as it was a classic study in market overreaction. The stock dropped because the guidance for Q3 was horrible. That's the headline. But what was missed was the reason for the poor guidance. Management was actively and deliberately slowing home acquisitions to liquidate inventory and de-risk the balance sheet in anticipation of the pivot. They were prioritizing operational discipline and capital preservation over top-line growth, which is a sign of a rational management team, not one in panic. Furthermore, they announced a $200 million share buyback program. While a buyback in a loss-making company can sometimes be seen as a questionable use of capital, here it was a bold statement of confidence in the underlying value of the business at a time when the market was severely doubting it. The market, fixated on the quarter-to-quarter revenue decline, largely missed the long-term structural improvements. This is where active management of your individual brokerage account, as opposed to passive, intelligent portfolio reliance, pays off by spotting the strategic move behind the disappointing numbers. The risks remain substantial, and this is where the skeptic crowd gets their fuel. First, Opendoor is still a net loss company, and the path to sustained profitability is a very steep uphill climb. Analysts project the company will remain unprofitable through at least 2027. Second, execution of the AI-first and agent-led model is a huge unknown. They're attempting to move into a space dominated by traditional agents and platforms, and successfully convincing agents to adopt their tools will take time and substantial investment in technology and marketing. The iBuying model was a direct-to-consumer play, whereas the new model is essentially a B2B and agent enablement play, requiring a completely different sales and marketing muscle. This is a point that traders using simple invest online apps like SoFi need to weigh against the short squeeze volatility. What about the competitive landscape? Zillow's failed iBuying experiment is a constant shadow, proving that even a massive data advantage isn't enough to overcome the fundamental difficulties of home flipping at scale. Opendoor has survived where Zillow exited, which provides a key competitive differentiator. They've demonstrated superior execution in a near-impossible market, even if they took heavy losses to do it. Now, with Opendoor embracing an agent partnership model, a major shift is underway. This is potentially disruptive to the traditional brokerage model. They're not trying to eliminate the agent anymore. They're trying to arm the agent with a superior cash offer engine and streamline transaction technology. This is a subtle but profound change in competitive posture that, if successful, could unlock significant, less capital-intensive revenue streams. For those using sophisticated analytical tools at places like Interactive Brokers to track stock movement, the current story is a classic momentum trade backed by a high-risk, high-reward turnaround story. The short interest is still elevated, meaning the pressure to cover is real, and any piece of good news, like a strong Q3 earnings report on November 6th, could trigger another violent upward surge. The primary focus on the next earnings call will be not just the quarterly loss, but management's commentary on the pace of the agent-led pivot and, crucially, the improvement in home resale margins and inventory days. If they can demonstrate that their pricing algorithms, which they are now augmenting with new AI capabilities under the new CEO, are more accurate and their inventory turnover is increasing, that will validate the new model and provide a foundation for long-term holders. The expectation that Opendoor is simply a victim of the housing cycle has been challenged by the reality of a radical, high-stakes strategic overhaul. The company is actively trying to transform its business into a tech platform that sits on top of, rather than compete directly with, the brokerage ecosystem. The stock price reflects the short-term tension of technical trading against a backdrop of fundamental, high-risk change. Ultimately, the future of Opendoor hinges on whether the new management team can execute its AI-first and agent-led vision and achieve sustainable profitability with a much lighter capital base. I'm curious to know what the investment community thinks about this strategic